Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Paul Sweeney. Join us each day for insight from the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. From Chicago, Anurag Rana joins us, Bloomberg Intelligence. Anurag, thank you so much for joining us. Is this a tech pullback, or is that just one part of the equation you see in the market?
Yeah, I mean, it is a minor tech pullback, but that's sometimes a healthy thing, because if you look at it over the last 1.5, 2 years, we have seen a massive rally in all these technology stocks because of AI. And right now we are at a phase of consolidation where the companies are spending a lot of money to expand capacity with the hope that they get more AI workloads down the road. So I think that's where we are right now. We're going to see this for a few quarters. And we think it's going to be a good 2025.
I went to the Anurag Rana FA screen today on Apple, and I noticed that Apple in the last 10 years has retired 37% of their diluted shares. I think historically, I can say, Anurag, it's never happened before. Are we going to see this trend of massive free cash flow from these companies where all the noise of AI and all really doesn't matter?
Yeah, when you see all the tech companies, I think Apple really stands out because their AI policy or strategy is different than the other tech firms. Last night, they actually bought back about 26 billion in shares that quarter. This is the highest we have seen. And this is a company that's not going to be spending billions in terms of expanding their data centers because they're rented from others. They're going to rent the large language model from everybody else. So their dent to free cash flow is not going to be as much as it's going to be for Microsoft and Amazon.
Anurag, only a 5.5% pullback in the S&P IT index over the last week. So you're right, not so strong. But talk to me about what we're seeing here. I mean, is this the beginning of? Should we be doubling down on growth, or should we be shifting into quality here? I mean, what are your thoughts?
So, Damien, when you look at it, there are two things that are at play right now. Right now, we are at a phase when these companies are spending so much money and they can't show a lot of the AI revenue. So investors are questioning whether that's going to happen. The second thing that you just mentioned is the rotation into value and rotation into small caps. And I think that's another play that's going to happen over the next several quarters, because the disparity between the large cap in the tech world and the small companies in the tech world is massive at this point.
I got to leave it there, Anurag. I'm so sorry to short you this morning. The news flow just exceptional. He is definitive on the cloud. Look for Anurag Rana at Bloomberg Intelligence writing up cloud forward. A couple years ago, here's the abstract. This chapter proposes a direct payment to individuals that would automatically be paid out early in a recession and then continue annually when the recession is severe. The outcome of this paper, direct stimulus payments to individuals, she will be hounded forever about the Somm rule. We are honored on this Jobs Day to have Claudia Somm join us out of Michigan, off the Fed, of course, with New Century Advisors, definitive and without question, the most followed economist in America today. Claudia, I don't want to get into cute, trite stuff. I'm not going to do the usual media interview. But what is the use of your rule, the wiggle room that it has? I think of DSGE, which can go 8 ways. How many ways can the Somm rule go, or is it ultra rigorous?
It's a tool. It was part of a policy proposal, an idea to do more fiscal policy, put it together ahead of time, design it well, tie it to economic conditions, take some of the politics out in the crisis, and hit go. Right? It was a tool to solve a problem. In the past, we haven't fought recessions as vigorously. It was developed before COVID, and so that's the idea of it. It's not. And it's a tool. It needed to be simple. It
Right.
needed to summarize a lot that was going on in the economy. Frankly, we have an economy right now that's extremely hard to summarize. So it's having a rough go of it. And yet I'm glad it's being helpful, I think useful to some extent in the conversation right now.
Let us look now at the jobs report of America. Coming out now, and it is a huge depression. It is a woe statistic as well. I'm going to go through this for a bit before we go to Claudia Sahm, and we're going to see major market moves here. S&P down 75 points right now. NASDAQ down 1.9%.
There goes the 10-year, 382.
382. Wow. The 10-year yield off of the numbers, which I'll give you in a moment, folks. The 10-year's in 17 basis points for global Wall Street. I'm not kidding. Ginormous fits the Friday morning tone, 3.80%. Here are the numbers, and I have the revisions now. The revision is a weaker statistic from 206 down to 179. The summed revision is negative 29,000. The non-farm payrolls is 114,000, below Dr. Wong's statistic, below the survey of 175. The unemployment rate explodes is too much, but hey, I'm in the media. 4.1% to a higher level, 4.3%. We'll have Claudia Sahm speak on this here in a moment. Tepid earnings on a month-over-month basis, which is what Ira Jersey looks at. It comes in weaker, 0.3, becomes 0.2. Weekly earnings, a revision weaker. The actual statistic, 3.7, becomes 3.6. You get the tone that we see out there. Labor participation actually is somewhat constructive. The underemployment rate, Alan Greenspan's favorite statistic, explodes is the correct word, 7.4%. to 7.8%. The VIX out two big figures, 2.29. S&P futures at negative 87. Claudia Sahm, I've got to ask the media question: is the Sahm rule in force at this moment?
Get triggered. Yeah.
Wow.
Yeah. So that puts it up over its 0.5 percentage point threshold. Noting that comes off of historical experience. That doesn't necessarily tell us where we are right at this moment, saying a recession. This has seen way too much momentum in the unemployment rate in recent months. I mean, 4.3%, right? This is not, so whether we are at that moment of a recession or not, this is your build into substantial weakening in the labor market. Right? Like we have seen potential. All is not lost. We are, the bottom is not falling out. We should never panic. There are policy tools, there are levers, and again, I don't overread one data point, but this isn't one data point. So I think the case now for, hey, we're normalizing. We did need to slow things down some, probably, generally speaking. But now the question is, okay, so we've had enough slowing here. What levels this out? And that, I think, I don't have the answer for that.
Claudia,
I think that's the big one.
An economist of merit, Claudia Sahm, by the name of Stanley Fisher, once lectured me and other worthies that the percentage move is important. The fact is we've gone up 0.9% from a 3.4% unemployment to a 4.3%. And that percentage change is ginormous. I'm going to give that to you folks in a moment. This is something you can do on the Bloomberg. It's actually way cool, to say the least. We've had a 26% increase in the unemployment rate, pandemic adjusted. I get it. How does that fit into your historical perspective, Dr. Sahm, on a move in the unemployment rate?
We have had a lot of disruptions in the labor force. So the supply of workers, you even go back to the beginning of the pandemic, millions of people dropping out, and then we had labor shortages, and then we had larger immigration coming in. Like, this has just been a lot, and we all know personally, and then also in the economy, adjustments can be hard if they are big and sudden. And we've had a lot of that. And so this is absolutely in there in these increases in the unemployment rate. We are still working through disruptions. And yet, underneath that is also a much more typical, pernicious, not good, increase in the unemployment rate of just there's less demand for workers. And if workers don't have paychecks, they can't spend. And then That's the momentum that gets
Right.
going. So it's the volume is turned up louder than usual on the SOM rule.
Right.
So I don't look at this and big picture say we are in a recession, but I look at this and I say we're we're not headed in a good direction.
Damien, get one more question in here. She has to speak to President Biden here in a moment.
Claudia, I'm a huge Guns N' Roses fan, and I love the song Patience, but I mean, waiting for waiting's sake is no way to conduct policy. That's not me. That's Neil Dutta. Talk to us about what happens in September now. Is this enough for the Fed to move?
Fed should have moved.
Should have moved already.
This was a discussion, and it's a discussion. I have been in the Fed needs to start. The rest of the economy was normalizing. The rest of the economy was cooling off. The Fed needed to do the same thing.
Okay, but Claudia, I'm going to go, Claudia.
But all is not lost. And they have a lot of lever to pull.
Claudia, I got Neil Dutta coming up. Okay, Damien nailed it. Okay, let's just forget process. We're out of a pandemic. Everybody, Krugman's going now. Dutta's going now. Sam's going now. Do they have to save face and wait till September 21? Or can they come out and go, when the facts change, we change, like Bill Dudley? And I'm sorry, make the adjustment at 4:30 p.m. this afternoon. Why not, Dr. Sam?
They have an ability to do whatever they think is appropriate. In no way, shape, or form do I think panic should be the theme for today or for any day of the Federal Reserve, frankly. And they will need to assess the situation. And this was not good data in the let's wait. But again, this is not overreacting. You can't go back and redo policy decisions. They have a lot of tools at their disposal, and we should be very thankful that there are these policy adjustments that can be made. That will help.
Claudia, thank you so much. Honored you could attend this morning. Dr. Sam, without question, the most influential economist in America right now with New Century Advisors. We turn to Neil Dutta, who's lost patience. He has an optimism on the American economy, and he's really pulled back and said, let's go. Where is the Dutta optimism this morning, Neil? Help me out here. I need to be optimistic. Where are you optimistic on the American economy?
Well, if you wanted me to say something optimistic, I'd echo what Claudia said. So thankful to be on after her. Quite an act to follow. Thanks, Tom. But I would just say that we don't need a troubled asset relief program. We don't need a resolution trust corporation. I mean, the problem with the economy is that monetary policy is too tight. And that means that looser monetary policy can help resolve the problem. And so, from my perspective, the Fed can just keep cutting until the economy turns. And there's a lot of room for them to do so. So I think that would be the optimistic sort of spin on things, is that, the Fed has plenty of ammunition to kind of, course correct here. I think they'll use it. And, this isn't about household balance sheet deflation. This isn't about corporate balance sheet recessions like '01. This isn't about an asset bubble bursting. This is just about monetary policy being too tight. The writing has been on the wall for months. Okay. I mean, this sort of let's wait, we get, spooked by first quarter data and waiting for the sake of waiting. I mean, this is what happens when you play that game, okay? And look, I mean, I agree that it's not worth panicking, and I don't think that this means that the Fed should move intermeeting or anything like that. But let's be absolutely clear about why this is happening. The writing has been on the wall for months. They didn't have a story to tell for why inflation would pick up.
That's right.
Every single monetary policy rule that they look at that's in their monetary policy report every time they go before Congress has been saying the same thing for months, which is a less restrictive policy stance is required. Now we're going to act all surprised when, the labor market's slowing in a more material way. And I will say, I mean, I do think it's going to get worse before it gets better, because when you look at some of the details within this report, goods producing industries saw a pickup over the month, Tom. Construction employment rose over the month. What do we know about residential investment over the summer? It's going nowhere. So the Fed's been kind of playing this game of chicken with the corporate sector where, the data has been strong. And so the Fed feels like they don't need to move. But the data's also been strong because the corporate sector thinks it's going to move.
Neil, let me get a data check in here, and Damien wants to crush you. The VIX, folks, at 20 level, out to a 21.26. And Miletti's aged off that. 2.67 full points here. On the VIX, we're now negative 97. On the Standard & Poor's 500, 1.8% down. NASDAQ down 2.57%. Damien says, I don't care about the equity market. I'm looking at bonds.
That's right.
10-year yield for I'm looking at the 30-year bond, thinking it's the 10-year.
You're missing the big one here. You're missing the big one here. Dollar yen down 2.5 big figures to 147.40. A stronger yen.
Dollar weaker because they think the Fed's going to cut.
So Neil, I have to ask you this: traditional safe havens. No one likes bonds. No one likes gold. No one likes the yen. But look at what's happening here in this market. But some of these moves are pretty big, and it is obviously an illiquid summer. Are some of these moves overdone, or is there more to go?
I mean, I think it's probably overdone for now, but I wouldn't be like selling fixed income here just because we had a sharp move. I mean, I think, you probably take opportunities with yields going up to kind of build on your position. I do think that, like I said, I think the data is going to dictate a lot of these sort of, high frequency moves. And like I said, I think the data is going to look worse before it looks better. And so I think for me, that means there's additional, like something like downward revision, something Tom's been talking about. We know that downward revisions have a momentum to them, right? So the fact that the numbers are being revised down kind of sets the table for the sort of direction of travel. Data.
Yeah, we heard that from Claudia Sam as well, and to have Sam and Dutta with us is great. Let me tell you, folks, we are commercial free across the nation to the end of the hour. Ira Jersey will join us now. He's publishing Bloomberg Intelligence, their interest rate outlook. We are thrilled that in moments we'll have Ann Miletti with us from Allspring Global Investments on the value that's out there as we see a dearth of growthiness this morning. Right. And with us right now, Neil Dutta, futures at negative 100 on the Standard & Poor's, Dow futures at negative 525, and again, the VIX 21.43. Damien to Mr. Dutta.
I'd like to ask you about that dearth of growthiness, Neil. I mean, that's a great way of putting it. The 10-year real yield down to 1.69% off another 7 basis points on this news. Talk to us a little bit about, it's sticky here in New York, right? It's hot outside, but sticky inflation seems like it's a thing of the past now. If I never hear sticky again, that might be too soon. Talk to us about inflation. Is that something we have just no interest in anymore? Is it all about growth in this market?
Well, I don't have any interest in inflation anymore. I think that was last year's story. It's a bit ridiculous. Again, Damien, it has to do with what's the mechanism? Right? Unit labor costs have been below 1% for the last couple of quarters. I mean, for crying out loud. Where's the inflationary impulse? The inflationary impulse from the labor market has been non-existent, in my opinion, for at least 3 quarters, 2 to 3 quarters. Okay. The Fed is just now saying that. So, I think this is really a function of, number one, they were spooked by the first quarter data, even though they didn't understand why it rose. It rose, and they sort of took more signal from that than they should have. It was more noise than signal. And they're allowing, the specter of the 1970s to haunt them. But the key distinction between this period and that period is that was a period of falling productivity growth. This has been one where productivity has largely been normalizing.
That's the key. That's I got to interrupt because that's the absolute key insight right now. I don't know which war they're reliving, but they're reliving a new war because we have new productivity. We talked to Clarida. It's pretty good. You have Richard Clarida, Bill Dudley, Claudia Sam, and Neil Dutta. I mean, that's a group of economists. Give one more to Duddy here before he goes and works.
Well, Neil, it's a new beta regime for sure, but, the old playbook seems to be kind of working here. Investment grade credit just crushing on this move in U.S. Treasury yields. And if you're right, and there's, not that much wrong with the corporate sector here in the U.S., is that a fixed income asset class that you want to own right now?
Yeah, I mean, look, like I said, I think just to take it back, we have a period of pain, I think, ahead of us. I mean, the next few weeks could get bumpy unless there's some kind of surprise Fed meeting. I don't think they'll do that because I think that might invite more panic than it's worth. But the Fed is going to get eventually on the right side of the 8 ball here. There's absolutely no reason to worry about inflation at the moment with the unemployment rate rising, unit labor costs slowing, oil prices collapsing. I mean, it's just a ridiculous thing to be even considering.
Right.
So that means I think the Fed is going to, start to, unload the cannon a little bit. And, for Wall Street, I think,
Right.
What I'll be telling my clients is 50, 25, 25, 100 basis points of rate cuts straight out the gate. I think the Fed has the space to do it, and I think that's the prudent approach at the moment. That's the prudent approach. 20
seconds, Neil Dutta, because Ann Miletti's going to walk out of the studio if I don't get to her. When you say 50, you're the first person to say this. Do they signal 50, Neil Dutta, or do they keep it a surprise and shock us September 21? I say they signal.
I mean, they should signal it, but I think more importantly is the guidance. They should say that they're willing to do what it takes to stabilize the unemployment rate, provided that inflation continues to slow.
Neil, thank you so much. It's great to have Claudia Sahm and Neil Dutta with us with this report. And again, futures at -93, Dow futures -466. Ann Miletti with us here. She wanted to go, she's in Milwaukee. Did you survive the convention in Milwaukee?
I did. I stayed kind of far away from it.
You couldn't even get to your offices, right?
Well, luckily, we are still in the suburbs in Menominee Falls, so I didn't have to, but we're moving downtown.
How do you, I'm so honored you're here today because we're doing traditional long-only buy-side. We're trying to do a short-term 3-year view, and you can hear the cacophony here from Dr. Sahm and Mr. Dutta. How do you use what you're hearing right now?
Yeah, well, you've had, some of the smartest people on the show already this morning, and it's really interesting to hear what they had to say. And certainly we pay attention to the macro, to the top down. But what's been maybe more interesting to me as an investor is the signals that we've been seeing from the bottom up, right? Looking at companies, listening to what they've been saying and telling us. And there certainly has been signals. And, we're seeing it in the reporting season. We've seen it not just in the numbers, but more importantly in the outlook. And those cracks really are real.
Yeah, well, consumer spending and whatnot. But, I'm looking at other data points. It depends which data points you look at, Tom. This credit card delinquencies look fine. I mean, I know the consumer's hurt, kind of taking it on the chin a bit here. But, fundamentally, things seem to be fine here in the U.S. Is there room for people to buy the dip here?
One, I think people tend to panic when they see moves like these. I think it's actually healthy because you had something priced into the market that likely was not sustainable. And the more we take out here, the better chance we have of not having a big disaster when things change. And so there are opportunities. Volatility brings opportunity. We're going to see more volatility.
We're going to see more volatility. We got a VIX up 21.41 right now, folks, back to almost an August normal, given the sweat of August over 3 decades. Ann Miletti, Intel's adjusting. Okay, let's call it a train wreck to be polite. But within the securities analysis at Allspring and the legacy of Milwaukee Strong, how do you adapt to the revenue shortfall? Church & Dwight, toothpaste, baking soda, came in with OSG, organic sales growth, a little light today. Citigroup went to a sell on an iconic New Jersey company. How do you adapt to the new revenue tepidness?
Tom, I think one of the things that you talk about a lot, which I think is really important, it's more than just earnings, right? It's been top line growth. Top line growth has been tepid, to say the least, for the majority of the market, except for kind of those concentrated names that we've seen. And, so when you see deceleration of growth, it's a sign. That's what I meant from those bottom-up cycles, or the bottom-up signals. The opportunity set, though, that lies in front of us is there's still names in each sector, not at all, but like most sectors that have been washed away, that still can outperform in a changing market.
Let me do a reset here, folks. If you're just joining us, a difficult and challenging jobs report. You heard on Bloomberg Surveillance, Claudia Sahm, formerly with the Fed, the Brookings Institution, Claudia Sahm saying her Sahm rule is in effect. She said that the moment after this jobs report with week revisions as well. Futures, not as bad as they were 10 minutes ago, -85. The VIX is going to give me 3 big figures right now, 2.71 figures, 21.24 on the VIX as well. The 10-year yield is what Damian Sassower noticed in 10 basis points now. Excuse me, I'm still looking at the 30-year bond, Damian. My brain's failing.
It's coming back.
3.84%. on the 10-year yield right now. Damian Sansauer to Ann Maletti of Allspring.
It was a lot easier, Ann, to get long the 10-year when it was at 4.25 just a few weeks back. Now we're at, 380 on the 10-year. I mean, talk to us about duration. Talk to us about the demand for incremental yield in the fixed income market. Does that make sense right now?
I think it does. I mean, one of the things that we put out in our outlook piece going back at the end of last year was this was going to be a year for fixed income. We also kind of warned about some softening of the economy. Now, look, we're midsummer or late summer, and we're starting to see these turns. But we do think that there's been opportunity. Our fixed income teams have been increasing duration. And, kind of believe that this would be the environment we would see. And so I think there still is opportunity out there. You just have to pick your points, to Neil's point earlier.
One final question. I got 20 seconds. What is the quality of a first place Milwaukee Brewers?
I mean, Tom, I'll take it. But as you know, it's still early in this season. And so we'll just hold our breath and cross our fingers.
Hold our breath. 565.
How about that contract for Jordan Love, though, huh?
I mean,
let's go to Green Bay.
If we could actually get 3 all-star Hall of Fame quarterbacks in a row, I mean, it would be a miracle. But
okay, there we go. What matters? Ann Maletti of Wisconsin, thank you so much. Of Milwaukee, legendary, strong, and of course with Allspring Investments. Coming up, the Secretary of Labor, Julie Su, will join us at 9:02 as our scheduling there. Catherine Greifeld and Anne-Marie Horton leading that conversation with the government on this difficult labor challenge. Joining us now, and Damian, I want you to lead off here with Ira Jersey.
Love that.
And I want to explain this, folks. A lifetime ago, you had on the desk at Credit Suisse a guy named Dominic Constam and a young lad, Ira Jersey.
Young lad.
And they were read voraciously on the street for times like this. Why don't you go to Ira Jersey on the love fest we see in fixed income?
Ira, the Fed has been in a deferred asset position for the last 22 months. That means it receives less coupon income than it pays out on its bond holdings. Talk to us about this quarterly refunding announcement. Talk to us about the Fed potentially issuing more, or the Treasury issuing more T-bills than coupon. Talk to us about the reserve repo facility. Talk to us about what's going on the front end here.
Wow, Damian! I thought we were going to talk about the 378 target that we just hit on our on one of our charts that we published.
Thank you for highlighting that, Ira.
One of our CMTs, and we bounced right off of that, and it's right now.
Yeah,
it's
but
holding.
I'll do that in a moment. But Damian's asking the pro question. Into the weekend, Ira, what's liquidity look like?
Yeah, so liquidity in the Treasury market is not terrible, right? Treasuries are still one of the most liquid assets, but relative to where it was, when Dominic and I were on the trading desk at Credit Suisse a decade or so ago, it was definitely it's definitely weakened since then, and there's a couple of reasons for that, right? One is yes, the Federal Reserve is running off its balance sheet, but one of the big changes that's occurred in liquidity and in the front end in particular is the fact that you have different repo products, right? So you just don't have a market, a funding market that's kept up with the size and growth of the amount of treasuries out there. Plus you have regulations like Dodd-Frank is a non-trivial regulation as well, because now you have less relative value players in the market. You don't have hedge funds who are trying to clip a basis point and a half in relative value between off the run and on the run treasuries in the same size that you used to have, because the leverage just isn't available, thanks to prime brokers and the like not having the same balance sheet capacity.
Over the weekend, for our listeners and viewers, they're going to look at their CD and say, why didn't I lock in? With this move in the 10-year, will we see cash in America look for a new spot come Monday?
Yeah, I suspect that people are terming out some of their shorter term assets, and they will do that, particularly I don't want to say the smart money, but away from retail investors. And that's one of the reasons why something like 2-year notes are going to catch probably even a bigger bid than you've already seen, because you're going to have people saying, okay, look, I'll lock in 3.5% now because in the future I might not be able to get that in my money market, right? So you wind up with people terming out their debt. Now, interestingly, at least in the near term and from relative value, something like the 5-year sector might actually outperform, because the market's going to keep on adjusting to where the terminal rate of the Fed is going to be. And one of the things we've been harping on is the 3.5% that persisted for the last 4 or 5 months. We thought was actually too high. So that's one reason why we think that the front end is going to even do better than it has so far.
Damien, get one more quick one in here.
Ira, 2s, 9.4 basis points, negative 9.4. We are almost to positive territory.
Wow.
I mean, talk to us about the curve. What should we be looking for there?
Yeah, so continued bull steepening of the curve. It won't be a straight line, right? We'll wind up getting a okay data report at some point, and we'll probably bounce back and people take off those trades. But we'll continue to see that curve slowly uninvert. Again, this is like a leverage issue because right now, since the Fed hasn't actually cut interest rates yet, right now those curve trades are very negative carry. So you have to have high conviction to stay in the bull steepener right now.
Yeah.
But I think you can have more and more conviction, and that will occur. Particularly after the Fed finally, makes its first cut. And it looks like now in September is almost a shoo-in.
Ira, thank you so much. Ira Jersey, who will publish this afternoon, look to Bloomberg Intelligence for that, a required read for a weekend global Wall Street. We're thrilled that Dr. Harris could join us this morning. Ethan, I slotted this in as a 3-hour conversation, and that got nixed by the Harris household as well. How does the Fed get out of this position? Do they wait for September 21? Do they jawbone it in speeches? What's the process you see with your study, the history of the Fed that they put in place to September 21?
Well, I mean, the Fed has been very lucky for the last couple of years, and suddenly their luck has turned dramatically against them. They were ready to cut, and then inflation comes in on the high side, and they go, whoa, wait a minute. Then they have a July FOMC meeting before they see the jobs report, and the jobs report comes in very weak. And so now, in hindsight, they probably wish they had cut at the July meeting. But going into that meeting, given the forecast for payrolls, nope, not going to do it. I think they have to start talking. It's very hard in August because most of these guys are out on vacation. I think earlier had mentioned that the board seems to be all out on vacation. But they need to start talking. They need to signal that September's definitely happening.
Ethan, I got to get one question in here because Damien Sassower, you should see it, folks. I'm sitting in our radio studio here. For those of you on radio, and Sassower's literally writing his must-read EM, economic and financial note here off of this jobs report, which is actually, this is how the sausage gets made at Bloomberg. Ethan Harris, I brought this up with Richard Clarida, Columbia Economics, and it's simple here. I see massive regret aversion. We got Tversky 101. They're really concerned about making a mistake. Do you sense that?
No, I think Mike had said this earlier in response to the question that they certainly at this stage think they're behind the curve, but given the information at hand. No, I mean, let's not forget, the first 4 months of this year, you had terrible inflation data. It wasn't just a little high. It was running at double the rate they wanted to see. And so it put a big, it really put a whole halt on the whole idea of rate cuts. Now they've gotten, the script is flipped very fast. So, I do think that they worry about the credibility of the Fed. We know that in the 1970s, the Fed made massive mistakes around inflation. We know that this Fed started to hike too late in 2022 and had to catch up. So there's a little bit of that legacy. You don't want to be remembered as Arthur. You want to be remembered as Paul Volcker. But, within the scheme of things, they're a little behind the curve. They'll catch up. I'm confident in that.
Ethan Harris with us, folks, of course, at Lehman and the Bank of America for years, actively out on LinkedIn. Can't say enough about that. Damien to Dr. Harris.
Dr. Harris, I was reading your note from earlier this week titled Slow and Steady Wins the Race. And I mentioned earlier, I'm a big Guns N' Roses fan. I love the song Patience, but you have Neil Dutta talking about 50 basis points in September, and you're saying the Fed's behind the curve here. Is there a chance that the market start pricing that in more confidently?
Well, they have. By the way, Neil and I worked together for quite a while. He's a good friend of mine. And I think this is a good, healthy debate. I think I was wrong I think this jobs number to me was a bit of it kind of hit me pretty hard. It's looking on like things are weakening faster than you'd like to see, and it's the payroll number that I'm most worried about. It's just this is starting to look shaky. When they go 50, well, the market's now pricing in about a 70% chance of a 50 basis point move at the September meeting. That's a really high probability.
Yeah.
You really have to believe the economy's heading into a recession to get the kind of cuts that are priced into the market now. Now, I think the risk of recession's rising, and that slow but steady story's getting is losing its validity. But to go 50 in September, we're going to have to see an even worse jobs report and continued soft inflation readings. So I think the market's overreacted. It's pricing in a Fed going at every meeting, including this 50 basis point kickoff cut. It's just the bond market overreacts, and today I think it's an overreaction.
Tom, you notice how Dr. Harris remembers working with Neil Dutta, but he doesn't remember working with me at Lehman Brothers back in the early 2000s. Thanks about that. Thanks for that, Dr. Harris. Yeah,
I'm just trying to forget. You cut his bonus in February 1.5 years.
I mean, come on.
Single-handedly did that.
Dr. Harris, talk to us. I mean, there's a lot of ambiguity here about where U.S. Treasury yields are headed next, obviously. But the consensus seems to be that we're going to have a steeper curve, certainly 2s, 10s. What are your thoughts here? Curve is now at what, -9 basis points? I mean, are we going to get there sooner rather than later?
I think over time the curve has to steepen. I mean, the risk premium priced into the bond market is crazy low. The bond market's pricing in no risk of inflation going forward, no term premium. It's just a matter of when. Now, of course, when the Fed starts cutting, it helps steepen the curve. But there's a more long run story here, which is just that the curve doesn't make any sense.
I mean, Ethan, they're coming out of the woodwork. Not only is Neil Dutta emailing in, Robert Sinch is emailing in. He's even more retired than Ethan Harris. Sinch.
He can't be more retired than me.
Bob Sinch really makes the important observation, a la Anna Wong, that we got birth-death issues. And let me quote exactly Robert Sinch. There is a residual seasonal adjustment problem. Ethan Harris, are we going to have all this data amend us down, as Anna Wong says, 30,000 non-farm payroll?
Yeah, I think that the estimates of modest kind of continued revisions where they go back and look at whether they're counting workers right and taking into account births and deaths of companies, there'll probably be some downward revisions. But the question is, are they going to justify a recession call? And that's a long way. I mean, we've been getting payroll numbers of 200,000 plus. I don't think you're going to revise that away. But they could slice, some tens of thousands off of these numbers, and we may find out with the benefit of hindsight that the economy had slowed a lot more than we thought. Certainly, that's what the unemployment rate's saying. It's been going steadily up. Some of that may be because the job market is a lot weaker than we think, and some of it's because of labor force coming back. But yeah, I think there'll be some downward revisions, and history will show this was a softer period than we thought.
Ethan Harris, my people will be in touch with your people. We're pulling you out of retirement. We're looking for a weekly slot. Ethan Harris, author of Bernanke's Fed. We're waiting for Jerome's Fed, Powell's Fed as well. But Ethan Harris there, of course, with the Bank of America years ago. This is the Bloomberg Surveillance Podcast, bringing you the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.